Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to go over another velocity banking review and talk about also maximizing our credit card power. Now, what does that mean? It's just a phrase that I made up about how we use credit cards with velocity banking because even though it's a debt payoff strategy, it doesn't mean we get rid of our credit cards. Okay. So, what is velocity banking? All it is a debt payoff strategy where you dump all your money into debt with the help of something called a line of credit. So, what's a line of credit? All is a financial tool where you can borrow money, pay back, and then use it over and over again. And as you can see here, I have access to a $280,000 line of credit. Amazing, right? $280,000. Look at this guy. He's like, man. Actually, I think this is a picture of me. Is that a picture of me? It probably was when I got access to this line of credit. So, if you don't know who I am, they also call me the goat of velocity banking or goat of debt payoff. Actually, that was ChatGPT because I paid off my mortgage in 2 years and 9 months. But let's not worry about that for now. I'll just casually throw that in there, just the way that Lopez casually throws in here in my garage with my Lamborghini. But yeah, right. So let's go ahead and go into velocity banking. So, what is velocity banking? A debt pay it's again, I'm repeating myself, it's a debt payoff strategy or use your line of credit as your main operating account. So the first thing in order for you to do velocity banking is create a budget. So we have two sides here, the average American and the velocity banker. And so what's the difference here? It's pretty much the same except that you're not going to have any savings. You see that? There's no savings at all. And in your budget, you have to list every single debt that you have. So you can kind of see here we have two credit cards, two auto loans, a student loan, a mortgage, and then we got our general expenses. General expenses. Okay. And so what we're going to do is make all of these go to zero, and then we're always going to have to pay this every single month. Now, here's the thing. Even though it looks like we're getting rid of our credit card debt, it doesn't mean get rid of our credit cards. And I'm going to tell you why we don't want to get rid of credit cards. In fact, we want to use all the tools that we can. But the reason why I don't want to get rid of my credit cards is that when you pay off your credit card statement balance, so credit card statement balance, and then you pay off in full, right? So you pay it off in full. Guess what happens? No interest, right? So that's the beauty of the credit card that your regular personal or home equity line of credit does not have. Like you can't charge things and then not be able to pay it off, or I'm sorry, not pay interest for like 20 something days, right? 20 something to 30 days, depending on your credit card issuer. And not only that, you get bonus points. Oh my goodness, bonus points. Yes. So what we're going to do is we're going to still use our credit cards when we do this velocity banking strategy, but we're going to only use it to pay for our general expenses. We're not going to tackle more additional debt, right? We're going to use it to pay our food, gas, insurance. And I don't know if you know this or not, but I have over $579,000 in lines of credit. I think 20 of them are credit cards. Okay, 20 of them are credit cards, and I just use those suckers and let the banks make a little bit of money with the interchange fees, so they don't charge me, but I still make a little bit of money, right, with the bonus points. And not only that, I delay interest. So even though we're going to get rid of our credit card balances, it doesn't mean we don't use our credit cards, and that's how we what I call maximize our credit card power. Okay. All right. So let's go ahead and do this. So I'm going to move some debt, and we're going to assume we have access to a $50,000 line of credit, right? But very few people will have access to a free and clear line of credit, especially if you're in this situation right here where you only got $200 left over in savings. Now, here's the thing. All right. Here's how you get lines of credit, or here's how you get any credit. Banks don't lend money to people who need it. They don't, right? And so if you understand this, it's almost like you'll never even get here, okay? But let's assume we had access to a free and clear line of credit. So what we're going to do is move these two credit cards, which I think is $40,000. So let's move this $40,000 credit card into an 8% $50,000 limit line of credit. And what happens when we do that? Well, these two simply go to zero. And guess what? Let me zoom up here. We literally went from $200 of savings to 1488 of cash flow. Can you believe it? Oh my goodness. Okay. And so now we're going to do the last part, which is we're going to dump our entire 6,200 into the line of credit, take our expenses out, and rinse and repeat over and over again. Now, here's the thing. We're not paying directly for our food, gas, and insurance from the line of credit. We're paying it with our credit cards. And then with our credit cards, we got like a 1 month float period. And then when we need to pay the statement balance in full, then I take it out of the line of credit as we're in our debt payoff journey. Okay. So let's go ahead and do this. And I'm going to do this. So I2 plus 1, right? Oopsie, not 2. We need to get the next month. And then we need to get the next month's balance plus the next month's interest minus our cash flow, which is 1488.16. And then we take the interest, which is based on the average daily balance, right? But don't worry, we're not paying 39 grand. And then we got to calculate by or multiply by 8%. But don't worry, we're not paying 3 grand. And then we divide by 12 because it's monthly and the interest is quoted annually. All right, so now let's go ahead and copy and paste. And after every single month, it's paycheck in, expenses out. And you know what? We'll probably pay a little bit less interest than this because we're paying the interest at the last possible moment and we have a 30-day float period, right? This is assuming that we have average expenses, or I'm sorry, we're using the midpoint between these two numbers, and that's usually not likely to happen to have an exact average daily balance, which is going to be the midpoint of the two balances. But again, this is just a good way for us to estimate when our debt payoff is, and we don't have to be too exact. All right, so now let's see how long it takes us to pay off these credit cards, which is about 30 months, right? So 30 months, we pay off the credit card. And I'm just going to go in here and type in 30 months. And that's going to be 50K, right? So not bad, right? Not bad. I mean, 50K, a lot of people would freak out about that. I've actually seen YouTube videos about 300,000 views about how to pay off 10K credit card debt in like 12 months. So 50,000 30 is not that bad. Now, we have these two auto loans, okay? And so let's go ahead and figure out what the balance of these auto loans are. So let me just go here. We have our loan calculator. I call it the calculator. Is that the right way to say it? I don't know. All right, so let me, what am I doing? I'm screwing up. All right, so I'm going to delete these, and then I'm going to delete these. Okay, and so now it's 16,000, 7%, 35, and 225%. So I think this is all right. And what I got to do is I have to figure out at 30 months. Okay, at 30 months, what's the current balance of the loan? And luckily, my loan calculator does that. So I just got to type in 30, 30, 30, 30, 30. And what I'm going to do is I'm going to pay off these two loans, these two auto loans first. And why do I do that? And why do I ignore the interest rate? Well, it's because I'm thinking only in terms of cash flow, right? So I'm going to get the $700 of cash flow back immediately instead of focusing on the 10-year student loan and the 30-year mortgage. So let's go ahead and do that. And I need to figure out what the balance of these two are, right? So let's go ahead and do that, which is 21 grand. So let's move that 21 grand here. And I'm going to copy and paste this. Okay. So now this is plus 21664.15. And then, all right, so now guess what this turns into? These two turn into zeros, and now we have increased our cash flow to $2,600 per month. All right, so now let's go ahead and do that and update our cash flow, which is minus 2630.42, okay? And then we rinse and repeat over and over again, and then we see that in 39 months, all paid off. Okay. All right. So again, we're not, even though these credit card payments are, it says zero, we're actually just transferring some of these other or food, gas, insurance to these credit cards, right? And then we just pay them off in full. So it doesn't mean we get rid of the credit cards. Like I still have like 19, 20 I can't even remember anymore, and that's a good problem to have where like you literally can't remember how much how much credit cards you have or how much money you have. And that's probably once you get rich at a certain point, you got money managers, right? So 91K. All right. I always thought the concept of a money manager was absurd. Like, oh, they charge you money to manage your money. And then I realized, well, if you have too much of it, and you don't want to pay attention to it, maybe it might be a good idea to have a money manager, right? But I remember when I first heard about the concept, like that's so absurd. But then it's like you make too much money and you don't want to pay. You want it to grow, but you don't want to pay any attention. All right, so now let's go into the student loan, and this is going to be 39. Is it 39 months? Yeah, it's 39 months. So this is 00. This is 39, 39, right? And all right, so now this is what I'm going to do, right? I'm going to do something called the chunking method. Anytime you have a interest rate difference, right? A huge, especially a huge one, you don't want to dump the whole thing into the line of credit. But what I've seen is that even if you use an 8% line of credit to pay a 6% mortgage, um, it's not that bad, right? Like we paid off relatively quickly. The sucker's gone. And so what I'm going to do is do something called, I like to call it chopping the loan into pieces, moving a piece of the loan into the line of credit. So instead of moving the whole 25 grand into the 50,000, which I can do, the reason I'm not doing that is because look at how itty bitty cash flow I get from moving that 25 grand into the line of credit, right? Not enough bang for my buck, and there's an interest rate difference. So if it's 8% like the line of credit, I don't mind moving the thing into the line of credit, not a problem for me. But if it's, a little bit lower, we have to be a little bit conscious of that we have a interest rate difference. And to minimize that, we use what we call the chunking method. All right, so how does that work? Basically, we'll move maybe like $7,000 into the line of credit from the principal of the student loan. So if I do like $7,000, okay, guess what? I pay off that 7,000 like 2 months, and if I do another $7,000 plus 7,000, we pay it off in about 3 months, right? So again, that's pretty quick for getting rid of 14 grand of a loan. And luckily, I have this Velocity banking calculator right here. That's kind of like plug and play, where I can easily just type in this stuff and give me a number as to how easily I can pay off all this stuff. So 6,200 is my income. This is how much I'm moving into the line of credit. And then now what I got to do is copy and paste this. Oh wait, actually this isn't right. I got to copy and paste this information. So 35 grand, 35, whoopsie. Whoopsie, control Z. All right. 35,000, 10 years, and then what's the interest rate? It's 5%, and it's 388.57. Wait, it's 6%. Okay, so let me sure you do that. 388.57, and then what's the current balance right now? Current balance right now is 25,828.35. 25,828.35. Okay, so half a year it's going to take us to pay off the student loan. So we'll just say 6 months, right? So let's go ahead and do this. So it's 39 plus 6, which is 45 months. Okay, and then this is now 0. So now this is 91 plus 35, and it's 126K. And then now we do the same thing with the mortgage, right? So 45 months. We'll just type in right here. And listen, I know what some of you are thinking. Oh my goodness, a 5% mortgage. Why would you use an 8% line of credit to do that? And the thing, my response to this is that, hey, it kind of matters, but it really doesn't, right? Like, so let's say I got a 0% loan, $220,000, 0% loan, and I'll just show you right here. So this is 30 years, 0%. Well, actually, I screwed up, didn't I? Oh, no, I didn't. No, I think I did screw up. My bad. Hold on, let me do this again. Because I didn't calculate the expenses correctly, and the expenses should have been 31181.01. So I gotta overestimate 31181.3181.01. Okay. So let me try this one more time. My bad. So this is 10 years, 6%. And then 25828.35. So 25. Oh wait, what's the payment amount? It is 388.57. 388.57. Okay, so 0.7 years. So we thought it was 6 months. It's probably around 9 months. So let me just kind of go back here. And so what's 39 plus 0.7 times 12? So that would be about, we'll say 48 months, be a little bit conservative. So 3 more months. Okay. So let's go back here and we're going to put in 48. Okay. So now this is what I want to show. Let's say we had a 0% mortgage. Okay. So 220,000, 220,000, 0% at 30 years. And what's the payment amount? It is 611.11. 611.11, and then this is $2,000 now because we got rid of the other thing. All right, so what's the worst that can happen? Oh, we pay it off at 4.5 years and we overpay by 1504. Okay, now the thing we have to be a little bit aware of, or kind of be suspicious of, is replacing your 0% mortgage with a line of credit. Because look at that, 52 grand. Now again, what's the worst that can happen? Oh, you overpay by $1,000, and sometimes like that's the cost of just origination fees in the mortgage. Now why do I show you this? Is because a lot of people freak out when they see going from a, let's say, even a 3 to 8 or a 4 to 8. Whereas I'm going to show you here that if you are talking about the worst case scenario, oh, what's the worst that can happen? You pay $1,500. I mean, it's literally a 0% interest loan, so you'll never pay over 220,000. But sometimes, okay, when we're dealing with like 3, 4, to even 2%, we can still save a lot of money. All right, that's just what I'm showing you. Okay, so let me just kind of go here, and what is the current balance? It is 205,986. All right, so 205 at 30%. And what is the interest rate here, which is 5%, right? So 5%, and it's 1181.1. All right, so look at this interest, what we would have paid had the loan just been left alone, 162,000, but we got rid of it in 4.6 years. All right, that's effing awesome. And again, here's the other crazy thing too, right? If you keep using your credit cards over and over again and just keep paying it off in full, the banks usually will increase your credit limit. So one of the reasons why you want to kind of always expand your credit base is number one, easy access to opportunities, and number two, cash flow management. So if you got rental properties and like a $10,000 roof goes out, put it on the credit card and just do this velocity banking thing, right? So not a problem. Okay. All right. So let me go ahead and now do this. So it's 48 divided by 12 plus 46. So 50 months, actually, I did that wrong. So 48 divided by 12 plus 4.6. Oh, did I do the math wrong? See, I'm only human. All right, so 8.6 years, and we are debt free. Okay, debt free. Look at that. Look at the beauty. Debt free. Can you believe it? Never felt so good, right? Never felt so good. I'm so like jaded with all of this. I'm gonna tell you why. It's because I have literally paid off my mortgage in 2 years and 9 months. So I do this so much to kind of brainwash myself, and then once I step into the real world, it's like, "Huh? You're not, you didn't pay off your mortgage in 2 years and 9 months? Really? Why not?" And actually what's funny is that every time I do these velocity banking demonstrations, I've never been able to get anywhere close to that. Now 4 years is pretty good, and it takes the average American 50 something years to pay off their mortgages because of refinancing and reselling, right? So think about that. And so it seems like home ownership in general is a possibly, I'm not saying calling it outright, a bank scam, right? Okay. Because they want to capture all of this. And when you pay it off quickly and you reduce it, there's a, I don't even know how to call it. Like, do you call it beautiful? Do you call it SEXY? What do you call it? I don't even know. All right, I'm just rambling on and on. All right, well, that's it for today, folks. So, This is your velocity banking review for today. It's a beautiful Saturday. Have a great day, and I'll see you on the next video.